Good evening. Is it time for an intervention for the good of our nation's health? For a long time now, our dear friend the British economy's had a problem and we can't ignore it any longer. It's addicted to cheap money that it's been getting from a bloke in Threadneedle Street. In the week that global markets reacted so badly to the idea of the US government ending their money printing programme, we ask, can we ever go back to the balanced monetary policies of the past, or are we permanently hooked on cheap cash and low interest rates? Here's Paul Mason.
Well, Kirsty, suddenly the global markets are turbulent again. There is a credit crunch in China. Across the world, people are selling off both company shares and government bonds. And because Europe's still the weakest link in the whole fragile global recovery and we are exposed to it, there is worry there as well. Last week, the boss of the US central bank, Ben Bernanke, gave the long-awaited signal that he's about to start withdrawing some of the $2 trillion printed under quantitative easing. Under QE, the Fed is currently buying up to 90% of all US bonds issued each month. That's kept the dollar low and the effective interest rate the USA pays to borrow at below zero. Quantitative easing works by making it unprofitable to own government bonds and pushing capital into other, more risky markets, into shares, property, gold and even the virtual currency Bitcoin. So by signalling an end to QE, Bernanke sparked a sell-off in the stock markets. And this is what happened. Here's the S&P in America, the FTSE in the UK and the Nikkei in Japan, all falling markedly since the middle of May. But just as the world's been getting used to that, there's been a mini credit crunch in China. For the past 5 years, the Chinese economy has been run on cheap credit created by the government. Using soft loans, China switched from consumer goods to massive infrastructure projects to help ride out the global downturn. But this year, growth has slowed to 7.7%, and instead of simply turning the taps on more, China's central bank has tightened credit. And this is what's happened to the interbank lending rate. The Shibor, a Chinese version of LIBOR, has spiked, making it hard for some companies to borrow, and some think this is just the advanced signal of a bigger Chinese slowdown. But what does it all mean here? Well, on Monday, Mark Carney, the new boss of the Bank of England, takes over. Here, too, we have quantitative easing, but unlike in America, we have a long and deep austerity programme underway and a weak recovery. So, not content with printing money, the government has asked Mark Carney to do more, ignoring the threat of inflation and pegging interest rates to zero for years to come. And the man he'll take over from, Lord Mervyn King, seemed to encourage that today.
I think people have rather jumped the gun in thinking this means an imminent return to normal levels of interest rates. It doesn't. And until markets see in place policies to bring about that return to normal economic conditions, there is no prospect for sustainable recovery. And without a prospect for sustainable recovery, markets can understand that it will not be sensible to return interest rates to normal levels.
In Britain, all this market shakiness matters because the fear is we become quantitative easing junkies. This graph shows the effective interest rate the government borrows at over 10 years. And as you can see, it's been falling, in part because we got the deficit down, in part because we did a lot of quantitative easing, and in part because the world calmed down. Now, at the very end, it's starting to tick back up again. And that's a direct reflection of all the problems in the world I've just described.
Paul Mason, well, Lord Miners is a Labour peer who had a career in finance before serving as City Minister in Gordon Brown's government. John Redwood is a Conservative MP and chair of the party's Economic Affairs Committee, and George Buckley is the chief UK economist at Deutsche Bank. John Redwood, first of all, has cheap money been good for the country?
Well, I think cheap money was a necessary evil to try and make sure the recession didn't get worse and spiral out of control after the credit crunch in 2007 to 8. But from the savers' point of view, it's been very bad news. Your
natural constituency.
And so you have to weigh it up. Some people gained, those who borrowed a lot of money. Some people lost, who were the savers. It didn't have much overall impact on spendable income because one lot won and one lot lost. But I think it was also much easier for the public sector than the private sector, because an awful lot of people are still having to pay much higher interest rates than the 0.5% we're told is the short-term rate.
But now it's almost at the default position. Are we addicted to it, do you think?
Well, I think this government and probably the new government of the Bank of England are going to say they've got to carry on with very low official interest rates for longer. They may find that bond rates, medium-term rates, go up a bit because of the world situation, and they may find that banks continue to require higher interest rates in the private sector, as they have been doing throughout the last 2 or 3 years. So I wouldn't say addicted, but I think it's part of the recovery process which they're going to want to keep in place.
Do you think we're addicted?
Well, I certainly think we've needed quantitative easing. Had we not had the amount of quantitative easing that the Bank of England's done, we would be in a situation that would be a lot worse. The only good thing about this, and this is probably one of the reasons I don't think we're addicted, is that had we not done QE, and in terms of people who've taken on loans, now we've seen some numbers from the British Bankers Association today saying that we've had a big increase, or a reasonable increase, in the number of people taking out mortgage debt.
Which the government's been desperate to have.
Which is encouraging news, but there haven't been that many people who've taken out debt at these exceptionally low interest rates. So that's the only good bit of news that we've seen.
But then when you get a hint from Bernanke that come next January, that there's going to be, the quantitative easing is going to be pulled back, there's such instability in the markets that they just can't take the news.
Well, I think this tells you how effective quantitative easing has actually been. It shows you how much interest rates have been brought down by quantitative easing in the first place.
How much we're conditioned by it as well now, though? Our response is conditioned.
We are, but I think we needed to have this level of interest rates.
Do you think it's been a good addiction?
I don't think it's been used properly.
No.
It bought time, and that time has not been used.
So if we knew it were there at the beginning, you didn't think this was going to be happening down the line?
No, but I don't think anybody foresaw that the recession would last this long. But we're now talking about a major part of the gilt-edged market being owned by the government. The government has issued debt and then bought the debt back. It's moved money from its left-hand pocket to its right-hand pocket. So we're going to have to see from the new governor a real change in more unconventional policies, even possibly cancelling out the two sides of the equation.
But the whole idea was, when it was brought in by a Labour government, that eventually this would kickstart growth. Well, where is the growth? We've seen growth in America. We haven't seen growth here.
Well, we've seen a positive stimulus to the economy as a result of quantitative easing. The Bank of England's evidence on that is very strong, and as George said, we're seeing further evidence of that. But fiscal policy has held the economy back. You can't put all the responsibility for growth onto monetary policy.
What do you think about the idea, Lord Mayor's idea, that you should be writing off some of the debt now?
No, I wouldn't be doing that, and I don't agree with Lord Miners that fiscal policy has been wrong. This government has actually increased current spending in real terms in the first 3 years in office, just as Labour did when it was in office. And the borrowing is still at a very high level. There's every evidence that there's plenty of fiscal stimulus in the economy. Where is the growth, you say?
Yeah, where is the growth?
There has been some growth, and there's also been a very big contraction of our two big lead sectors of the previous decade. Oil and gas has contracted because the reservoirs are getting old, and banking and financial services and business services have been very badly walloped by the credit crunch under the previous government. So when your two lead sectors are that badly damaged, you have to run very fast to catch up.
Well, you can't do much about the first sector, and the oil price is so volatile, but you certainly could have done something about the second one.
The government could have introduced more supply-side reform. It could have increased capital expenditure instead of reducing it. One of the problems in government...
Well, it was your government that cut it.
One of the problems in government accounting, this is not a party political point, John, is that we lump capital expenditure together with revenue expenditure. And the one thing we should be doing when we have excess capacity in the economy is building roads, building schools, building new railways. And this government has been very
well, from the point of view of an economy, you're an economist at the bank, would capital projects have made a massive difference? They seem to have made a big difference in America.
Well, what we can do is look at the multipliers in terms of what an increase in spending on capital does to the economy versus what an increase on current spending does to the economy. And when you raise capital spending, it does a lot more to boost GDP than does current spending. So I think capital spending is very important to maintain.
Why do you think that the capital, this government's been shy of big capital spend on big projects?
I don't think it has at all. I mean, the previous government made extremely large cuts in future capital programmes. This government has put a little bit of those cuts back and wants to put a lot more back, and has come up with the National Infrastructure Plan.
John, those cuts were during the eye of the storm. They were not part of a longer-term policy. They were during
they were set out for the following 5 years.
During the acute part of the crisis.
They were your long-term policy.
And they weren't. There wasn't a 5-year commitment to fiscal policy in 2010.
So if the Labour government was in just now, you'd have returned to big capital projects. It'd have been, I don't know, HS2 would have been brought forward. I don't know what would.
Well, there are plenty. We only need to look at our motorways and our roads to see plenty of holes that need to be filled. This is precisely what John Maynard Keynes said we should be doing during a recession.
And the capital, and what George is saying is that capital projects have a huge multiplier effect, whereas current spending doesn't.
I agree that some capital projects are a very good idea. There are also some very bad capital projects that the public sector can do that curse us with huge revenue losses and subsidies in the future, which are not a good idea to do. So this government is looking at what could make the best impact. Broadband is a very good investment, which they're encouraging, for example.
At last.
But if you want a very big railway, as some people do, it takes about 10 years to go through all the permissions and
looking beyond our shores now, beyond America, how worried should we be about what's happening in China, for example, about the latest tremors?
Well, interest rates will have to normalise. At some point, they need to be at something around nominal GDP plus 1 or 2%. At the moment, they're
so we're never going to get to 5%, 7%?
Oh, of course they will get to 5% again at some point in the future. And that's big issues for people on interest-only mortgages or fixed-rate mortgages.
At some point, I mean, Japan, 20 years.
Well, I would hope, regardless of the mismanagement of the economy by this government, that we're not set for 20 years
but seriously, what do you think?
Well, I think it's worth bearing in mind that at the moment, 10-year interest rates are 2.5%. Now, that is not, even after having risen so much over the last week, it's still not a number which suggests that the market is convinced that this recovery is serious. 2.5% is still not consistent with a strong recovery.
So what would convince the market?
Well, the market would have to see interest rates much higher than that to be convinced. Now, the problem is that when interest rates go up, you start to worry that it could actually have a negative feedback loop, and this is exactly why we're so worried about the speed of the rise in interest rates we've seen. Ben Bernanke has said that he's going to be thinking about scaling back QE. We did that. We actually stopped QE on a single day back in October of 2012, and it didn't have this impact on the UK markets. But the US is so much more important and has an impact on every other country.
So we are living in America's world.
Well, I think, yes, America has much more purchase over the rest of the world because she does everything on a bigger scale, because she's a bigger economy. I think also the coincidence of Bernanke's perfectly sensible words with the Chinese decision to really push their banks and financial institutions and to say to them, you've lent too much, we're now going to stop you, was what caused the crisis. And what we've got to watch is, do the Chinese authorities back off at any point, or do they want to actually precipitate a worse situation in China, in which case it's going to be very bad for the rest of the world.
You began the conversation saying that the low interest rates clearly were very bad news for savers, your natural constituency. When do you think they're going to return? Do you expect of Japan, not hangovers?
I don't foresee the official rate going up this Parliament. I think we are going to be on a long workout. I think the economy will grow from here, but it won't grow fast enough to justify suddenly jacking up official rates.
5 years, 10 years,
and I think
a decade
official rates
of
in America are going to stay low for longer too. They've said they want to get unemployment down substantially from this level before they increase them.
Because the paradox of government policy at the moment in monetary area is we're repeating the same mistakes that were made in monetary policy by the Bank of England in 2006, 2007. We're stoking up asset bubbles, we're creating uncertainty and risk in the economy. There will need to be an adjustment. Whether it's in the course of this Parliament or beyond is a matter of a debate, but interest rates will have to go up in due course.
Thank you all very much indeed. And we're joined by our political editor, because tomorrow the Chancellor, George Osborne, will announce his spending review, Allegra. Damp squib, lots of tweets have gone out, but do we know much?
Not very much. It's very unusual that the Treasury doesn't say very much the night before one of these. Makes me think he might be up to something. But actually, all suggestions are he'd quite like tomorrow to be boring, because he's got in trouble in the past where these financial statements have been. But look, the thing that is relevant to the contributions by your previous guests is that they thought that the deficit would have been coming down, all sorts of things with growth not transpiring means that actually George Osborne had to extend it through to 2018, which is a very long time in the future. Tomorrow what we're getting is the first tranche of how you get on that new trajectory. It's £11.5 billion. It's something, but it's just a dress rehearsal. So we get cuts tomorrow, but actually to get to that further target of 2018, into the next Parliament, we'll have another 13 billion in 16-17, the years 16-17, and then after that, yet more. So tomorrow we learn a little bit about what life will be like in the next Parliament, but not a huge amount. I also sort of sense that it will be sort of, terrible phrase, but salami slicing. So it will be efficiencies there and backroom savings here. There will be pain, but you get the sense that he's wanted to make it not particularly pyrotechnical. The thing about these is that Labour has now moved on to broadly supporting them. So a lot of the politics has gone out of it.
Thank you very much indeed, Allegra.